Welcome back to Investing Talk Podcast.
Today we're looking at HIMS and HERS Health. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. HIMS and HERS, huh? They've been on a tear, growth-wise.
Oh, yeah. A real telehealth giant. We've got a stack of analysis here looking at, well, everything. Their crazy growth, but also some pretty confusing stock moves lately.
That's right. We're talking 73% year-over-year revenue growth.
Yeah.
Impressive stuff. But yeah, there's volatility and some big strategic changes happening too.
So what we really need to figure out for you, the listener, is this. Is HIMS and HERS a solid buy right now, or are those recent stock drops, a warning sign?
It really feels like a pivotal moment for them. They're trying to balance that super high growth with, well, investor expectations, regulatory stuff, and some major shifts in how they actually do business.
Okay, so how are they managing all that? Expansion versus profits versus risk.
That's the million-dollar question, isn't it? Let's start with the confusion around Q2 back in August, September.
Right, because the earnings themselves, they looked pretty good, didn't they?
They did. Adjusted EPS was $0.19.
Yeah.
That beat the street's $1.15 expectation. And adjusted EBITDA, $82.2 million. Solid numbers. Shows real profit growth.
Exactly. Strong profits. So why? Why did the stock drop like a rock right after fell, 12.4%?
Yeah, it's a paradox, right? Beat expectations, stock tanks.
So what gives?
Well, it seems like it mostly came down to expectations. The stock had already run up so much this year. The market wasn't just expecting good, it was pricing in like mind-blowing results.
So it was a sell the news kind of thing, profit taking?
Pretty much.
Yeah.
People who'd made money on that run-up just decided, okay, time to cash in some chips. It wasn't really about the numbers being bad, just not, superhuman enough to justify where the stock had gotten to.
Okay, that makes sense. Expectations game. So more technical selling than a fundamental problem. Did it find its footing after that initial drop?
It did, yeah. Things got volatile for a bit. I mean, weekly swings of nearly 12%, but then in September, it settled down. Found a range.
A trading range. What are the levels there?
Seems to be holding pretty well above support, around $40.87, but bumping its head against resistance near $70.43. So, stuck in that channel for now.
That $70 mark sounds key. Is there momentum building underneath that could push it through?
Actually, yeah. The technicals are, surprisingly, maybe quite bullish, despite that range.
How so?
Well, it's staying consistently above both its 50-day and 200-day moving averages. That's a good sign. And the MACD indicator.
Remind us what MACD tracks again.
Sure. It's the moving average convergence divergence. Basically, it looks at the relationship between different moving averages to gauge momentum. And right now, it's showing positive accumulation, meaning buyers are still stepping in even if the price isn't breaking out yet. It suggests the market might just be, consolidating, catching its breath before the next move.
Okay, consolidating, waiting for a catalyst, perhaps.
Yeah.
Which brings us to their actual business. Where are they making moves? You mentioned strategic shifts.
Right. We need to talk about their core business, and specifically the GLP-1 segment.
Okay, let's pause there. GLP-1s, for everyone listening, those are the weight loss drugs, right? Like Ozempic, Wegovy, huge market.
Exactly. Probably the hottest area in pharma right now, which makes this next part interesting.
Go on.
Our sources show their revenue in that specific GLP-1 segment fell sequentially, dropped from $230 million down to $190 million in Q2.
Whoa. Okay, that does sound like a problem in their hottest market. Why the drop? Competition finally catching up.
No, actually. It seems it was planned. Strategic.
Planned. How is losing revenue in a booming category strategic?
They shifted away from just filling standard prescriptions for branded GLP-1s towards pushing their own personalized compounded formulations.
Compounded meaning?
Meaning they work with pharmacies to create custom versions, potentially tweaking dosages or combining ingredients. This move, it hit the top line temporarily as they transitioned.
Okay, but why do that? What's the long-term advantage of selling less of the hot branded stuff?
Control and differentiation. It's about building a moat. By moving to compounded versions, they have maybe more control over supply, potentially better margins down the line, and they aren't just reliant on Novo Nordisk or Lilly's pricing and availability.
Ah, I see. So less dependence on big pharma, more control over their own destiny in that space. Plus, personalization probably helps keep customers sticky, right?
Exactly. It ties into their whole platform strategy. It's not just about drugs. It's the telehealth platform, the diagnostics, the lab testing they're integrating, the AI they're using. They want to own the whole patient journey.
And is that personalization shift working? Are customers buying into it?
It seems like it. The data showed a huge jump, 170%, in people signing up for these multi-condition personalized plans during that same period. So fewer maybe initial GLP-1 scripts filled, but deeper engagement from the users they have.
And that platform experience? Users like it.
Apparently so. Found a white paper mentioning 94% of their users feel the experience is as good as or even better than going to a traditional doctor's office.
94%. Wow. That's strong validation for a digital model. Okay, so the core business pivot makes sense. What about new growth areas? Big bets.
Okay, yeah, the really big news came in October. They launched a whole new specialty service under the HIMS brand focused on menopause and perimenopause.
Menopause. That's a massive underserved market, isn't it? What's the potential there?
Huge. Management is talking absolutely massive numbers and projecting this one initiative, just the menopause vertical, could bring in up to $1 billion in annual revenue.
Wait, say that again? 1 billion.
$1 billion just from menopause, potentially starting as soon as 2026.
Okay, that's transformative if they can pull it off. Puts the current revenue numbers in a whole new light.
It really does. It underpins a lot of the bullish case. And that's not all. They're also pushing internationally. Remember that Zava acquisition in Europe?
Right, the UK-based telehealth company?
Exactly. That gives them a platform to scale this whole digital health model across Europe using existing infrastructure. So domestic growth and international expansion.
Any other potential catalysts on the horizon? Rumors, maybe?
Well, there's always chatter. Persistent rumors about a potential big partnership with a major pharmacy chain for distribution. That could really help with fulfillment and maybe lower customer acquisition costs.
Okay.
And whispers about new AI features being unveiled soon. If they can use AI to make care even more personalized, or, crucially, make getting new customers cheaper, that flows right to the bottom line.
Lots of potential upside then. But we need balance. Let's talk risks. What keeps a HIMS and HERS investor up at night?
One word, really. Regulation.
Specifically around
Those compounded GLP-1s. Again, because they pivoted into that space, they're now more exposed if the FDA decides to tighten the rules or crack down on compounded drugs in general.
which the FDA has signaled interest in doing, right?
Yeah, they have. There's heightened scrutiny. Any new rules, any enforcement actions that could hit revenue fast and hard. And it would definitely spook investors.
Yep.
It's the big one outside their direct control.
Okay, major regulatory overhang. What about financials? Profits are up, but what about debt?
Good point. Net income tripled year over year in Q2, which is great. But the debt-to-equity ratio, sources put it at 172.3%.
Oof, 172%. That sounds high.
It is moderately above average for the industry. It suggests they're using leverage to fuel that growth.
Is that manageable, you think? Especially with that regulatory risk you just mentioned, if growth slows suddenly.
That's the tension, exactly. Management would argue that super high growth and cash generation make it manageable now.
Yeah.
But you're right, if regulators slam the brakes on GLP-1s, that leverage could become a real problem fast. It relies on continued execution.
And execution itself isn't guaranteed, right? Integrating all these pieces, AI, diagnostics, international stuff like Zava that adds complexity, integration risk.
Definitely. Scaling smoothly across all those fronts is a challenge. Lots of moving parts.
Okay, so looking ahead near term, what should listeners be watching for? Key dates, events.
The big one is coming up soon, Q3 earnings. That's scheduled for November 15th.
What are you looking for in that report?
Continued profit improvement, obviously, but also any commentary on how those personalized plans are ramping up, maybe early signs from the menopause launch, and of course their outlook, especially regarding GLP-1s. Expectations will be high again.
Any other dates?
December 6th, that's the S&P Morgan Stanley ETF quarterly rebalancing. If HIMS and HERS gets included, or has its weighting increased in major ETFs, that could drive serious institutional buying.
Could that be the push needed to break that $70 resistance?
It could definitely help, yeah. Provides buying pressure independent of just earnings news.
All right, so wrapping this all up, where do we land on the investment thesis? Strong growth, big new market potential, decent technicals, but this looming regulatory shadow.
Look, the overall take seems to remain, pretty bullish. Most analysts covering it are positive. The rationale boils down to they're a leader, They're executing well on a smart strategic pivot, and the technicals suggest it might be coiling for a move higher. That $1 billion menopause number is hard to ignore.
So the consensus is bullish, assuming they navigate the risks.
Essentially, yes. If they can pull off the menopause expansion and manage the tricky GLP-1 regulatory environment, there's significant potential upside from here.
So for you listening, it's a compelling growth story, no doubt, but one where you absolutely have to weigh that massive potential against a very real external risk factor.
Right. And maybe that leaves us with a final thought. When you're looking at a disruptor like this growing so fast, how do you balance the excitement of those huge future projections like the billion for menopause against a risk like FDA regulation, which management can't fully control? It means you need to watch the FDA news almost as closely as you watch their quarterly numbers.